Welcome to the State of the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special returning guest is Dave Hunter. So, Dave Hunter, welcome back to the show.
Yeah, hi Paul, great to see you.
So we've also got Tim on the line, and he's not on the video, but he is going to jump in.
I'm maintaining a discreet difference for political purposes because I've been selling treasuries recently.
Yes, which we will.
Hi Tim, how are you?
Dave asked how you were, Tim. I don't know if you heard that.
Yeah, I'm good, thanks. But increasingly, I was saying to Paul just before we started, increasingly baffled by the geopolitics. Just when you think it can't get more insane, it gets more insane.
Well,
it sure does. There's a lot going on.
So before we actually get onto the insanity, let's just kind of recap. Dave, you were last on in November, and that was before the big move up in the precious metals market as well as the equity markets. And it's fair to say that nobody was talking about the big move ahead, apart from you and just very few others. But the melt up was your description of how this would all go off. And actually, we had an interview with you before then, again, and we discussed at length about how this was going to accelerate higher. So let's just say that all your forecasts will park them under kind of phenomenal, because they have been. And I just want to ask, with regard to the silver one, which at that time it was trading around $47, your target was 100, it overshot that. As it was rallying in that kind of phase that everyone started to get extremely excited, I'm sure people were kind of phoning you up and saying, should I be buying silver? Or people would come out of the woodwork and saying, should they be buying precious metals? What was your contrary view? Because you're a contrarian there. Did you start to feel like it was time to sell?
I'm not a trader, so I don't get too much into trying to call that kind of thing. But I did, in my January letter, raise my target to 125, and that came out in the first 10 days of January. And then we went even more parabolic from there. We got up to 122, so not that I was expecting it to happen quite that quickly, but I did have a podcast that I was doing with somebody, I don't remember who it was, that week. And I said in that podcast, I think at the time silver was 117 or somewhere down there. And I said, this thing's up on stilts. It's run very fast. It's not the end of the silver move, but it is you could see a very sharp correction from here, very shortly. And I said, it might be 35% in silver, might be, 20% or a little more in gold. And so within, a few days of that, we topped out and rolled over. I did not see 50%. I did not see, we got down obviously ultimately to 55 or 6. I didn't see that coming, but I was pretty sure we had gotten a lot of speculative fever in there, and it was going to reverse sharply just like it went up. And I thought we'd reverse for a few weeks or a month and then be merrily on our way again. But obviously the correction's took 6 months. I do think we have bottomed in both gold and silver. From that, in that long consolidation, and that we are starting the next leg up. And I've raised targets again. I raised them in, I think, late January, early February. And I do it, people don't understand, I'm not a momentum driven person. I do it the opposite. It's when I see things set up, as I say, the sum of my analysis, but it's also sentiment, etc. So I did, while I was expecting the correction, I raised my target to 180 on silver, and I think 6,800 on gold. And then I think in May, I raised it again to 200 on silver and 7,000 on gold. And that's where I'm at today. So that's kind of where I see this cycle topping out. There's a fellow you guys may have interviewed. I don't know, Michael Oliver out there, who is talking, potential for $300 to $500 silver this cycle and maybe this year. I just can't get there. I don't think he's crazy. I think that the setup here is possible that you could well exceed my 200. I just can't get there with my analysis. So 200 is where I'm at.
So with regard to the sense that the market was topping just on the previous silver top, was that just intuition, just market chatter and sentiment, or was there something specific that you looked out for, or a warning sign that said this is overdone?
Yeah, it wasn't, and I don't make trading calls, but it wasn't necessarily saying silver's topping, because I felt there was much more upside after we got some consolidation. But it just had gotten to a point where, you go for, as you say, you went from 47 to 122 in 2.5 months. I mean, that's just, that's ridiculous in terms of how fast it got there.
Yeah.
And everybody who was questioning silver was now all in. Everybody was bear and bullish. And frankly, the 6 months that followed that had a lot to do with the fact that, as you know, people ignored me and criticized me with my call when silver was 25 and 30. And I was saying it was going to 75 and then raised it from there. And now all those critics, not just retail, institutional, that were all those non-believers back then, were now believers at 120. So, that just is a sign you just can't continue something like that for very long. Now, Micron has defied the odds and gone higher and higher and higher. But it was kind of a similar move to what Micron did, just not nearly as long or as big as that one. But it's the same kind of thing where when you go vertical, you're going to have to consolidate that at some point. And I thought, speculation had just gotten out of hand. So, it happened pretty quickly after that. I wasn't sure how, the exact way it would play out, but, I'm a contrarian, so it was pretty easy for me to say, this thing's overdone on the upside, at least short term.
So I remember the podcast before that, we were talking about the bunker hunt squeeze and how when things go, they can really, really go. And because I know you also look at technicals as well as your macroeconomic forecast. So you would understand that, of course, by looking at how price action can move when the market starts to run. The differentiation here is that after a run like that, someone might assume that we've hit the ultimate top because of this kind of inverted commas crazy run, but yet your fundamental analysis, your macro analysis, is saying that this is a buying opportunity. Not necessarily you're saying it's buying. You've still got higher targets. You say you're not a trader, obviously, and it's just more a macro forecast. That in itself is exceptional, because looking at it from a technical point of view and how the market looks like it's made some form of topping formation, ordinarily I'd be looking at that and saying, well, this volatility would almost be predicting a much bigger correction. And actually that pattern's just recently been rejected and the market's moving up. So once again, it's kind of moving in line with your macro forecast. What is it about the gold and silver markets that you think has more upside? What's telling you that this isn't over?
Yeah, one of the big things, and by the way, you're right. Normally a parabolic move like that would, in the way I do things, probably trigger say maybe this is the end. There wasn't even a doubt in my mind that this wasn't the end of it. It didn't take me long to say, yeah, we're going to have a correction. Like I said, it exceeded my expectations, but all the way through the consolidation of the last 6 months, or that 6 months, I remained one of the true bulls on the street in silver. It didn't cause any anxiety for me that this is over or that we're going. You heard calls for 50 and 40 and lower. So that is kind of I think for me. I'm not dogmatic. People, a lot in this business will have one way they do things, and everything, if it goes that way, it's going to be that. It's kind of, as I say, it's some of my analysis, and I just knew silver is not at all done yet. in even in this cycle. Part of it is that the dollar hasn't even really begun. The next leg down is just beginning now. The next leg down, and I have for a long time said we'll see the dollar down to 82 or 3 on DXY. So, everybody, when it was up over 100 and went to 101, it was all of a sudden all the calls were, we're going to 110. Maybe we're going back to the highs of a few years ago. And I said, no, this is just it's been a long 1 year consolidation, but it's a counter trend rally in a dollar that's in the downtrend. So it came down from 115 to 95 or 6, went back up to 101, and now we're rolling over. And I think the next stop is probably 90 on the way to 82 or 3. So the dollar to me was a big key that, silver and gold, have plenty more upside once that gets going. Again, I'm a bull on bonds. Everybody's a bear on bonds today. Lower interest rates will help silver and gold as well. Another part of it, obviously, play a big role in this last 6 months or more, is the Iran conflict. And that probably caused me to underestimate how long the consolidation was going to be. Very, very definitely, the trade in silver and gold was a risk-off trade, and people don't understand that. They think, well, wouldn't you want in a conflict, wouldn't gold do well? The problem is gold and silver have been in big bull markets here, and have traders have loved them, and so there was a risk-off trade. They went more with equities than they did with something that goes contrary to equities.
So it's actually interesting that the possibility of gold and silver running up, because maybe the market actually knew that the war was going to happen and therefore was kind of preempting it. It was the final push. And then, as we know, once that kind of news comes out and everyone says, "Oh, we've got to buy gold and silver because of war," it's too late, and you get this correction. So that would fit in, and also with the dollar bounce. And I know that you've been steadfastly bearish on the dollar with targets in the DXY at 80. So obviously you're keeping those targets, but
it's my target right now is 82.3. I think I raised from 80 a couple of years ago, but somewhere down low 80s.
Yeah, but basically, so it all kind of fits in together how precious metals would rise, equities would be in a risk-on position because a weaker dollar helps that. And also another kind of outlier call is at the moment yields, which we will get onto. But I was just going to say, of the bulls out there, obviously Tim's fund has been positioned very much with precious metals and commodities. So there have been some other players who've seen this coming and have been kind of waiting. And just while Tim's on, I mean, I just wondered, Tim, are you still very much of the opinion that this has got more to go, or are you even more bullish, or what's your
I mean, the danger is that you come across like you're talking your book, which clearly I will be anyway. But the reason I struggle with some of the analysis of markets now in relation to what is the fair dollar value of X or Y is that if your fundamental belief is that the dollar is en route to being worthless, then some of these markets could be worth infinite dollars in the fullness of time. So in other words, what is the fair unit of value? I've had the benefit of knowing some people who've spent a lot of time thinking seriously about the likes of gold and so. I think gold, for example, is the most misunderstood asset on the planet. I think because most people have never really owned it, and most people don't really understand money. But some people who've thought a lot more intelligently than I have about gold say, how can you measure gold using a dollar? So the analogy is, what's a kilogram? So a kilogram is defined as the given mass of a given amount of material in a laboratory in northern France at a given altitude at a given temperature. What's a dollar? So their argument is that trying to measure gold, or for that matter anything else, using a dollar is like trying to measure a suit using a piece of elastic. And that's, I think, where we've got to, where I've certainly got to now. That I'm a bear on bonds, a bull on precious metals and commodities and real assets generally, specifically because I'm a bear on fiat currency. So in extremis, I think it was Voltaire said that any fiat currency ultimately trades at its intrinsic value, which is zero. And it just seems to me that the way the Bessent administration or the Trump administration, whatever you want to call it, is behaving, it's if they're like the gang that can't shoot straight. So we had Russian sanctions, which I remain convinced will go down in history as one of the worst self-inflicted geopolitical wounds of all time, because it's been completely counterproductive. It's just basically forced central banks to buy gold. And then you've had the invasion of Iran, and now you've got the US sort of doubling down. There's a David will have seen there was an op-ed in the Wall Street Journal by Stanley Druckenmiller, who was sort of Scott Bessent's colleague back in the day when George Soros was destroying the Bank of England and the pound. I think it was Mrs. Thatcher said, you can't buck the market. Well, Bessent's trying to buck the market. I don't see how he can possibly succeed. Discuss.
So you just gave, I think, pretty much where most of the street is, where most of the world is in terms of a view.
But they're not. They're not in gold
surprised.
and silver. Sorry to interrupt, David. The reason I would double down on this is because it's admittedly one data point, but I think it's UBS have a survey of family offices, and in their latest family office survey for 2026, the average family office has zero exposure to silver. This is not a crowded trade.
Yeah, no, you're absolutely. I'm right with you on gold and silver. So rationales probably differ. My worldview very much differs. My view of Trump very much differs. I get that that's where most people are on Trump, and on the war with Iran, and on what's going on in Ukraine and Russia. I do think when the dust settles and we look back in history, we're going to find that it's not anything like what the world views at this point. I think there's a far too bearish view on where we are with Iran right now. This idea that somehow Iran won the war or is winning the war or is in good shape. If this were reversed and we were the one in the position Iran is in, the world would be saying, man, the U.S. is done. So a lot of this is kind of TDS. I'm not saying you're viewing it through TDS glasses, but a lot of certainly the U.S. view of Trump and what he does.
I mean, that's clearly been wildly
does not
politicized.
allow Trump to do anything right.
I don't doubt that. I think my skepticism comes from more. It's not a country specific skepticism. It's a global skepticism, which is, I think we're living through the last days of a debt empire. And in the UK, we're not far behind. I mean, we've just got to 3 trillion, which seems like chump change by comparison, but we are all insolvent.
Yeah, you're preaching to the choir. As you know, I think we are going to see a systemic failure of the world financial system probably out in the mid-30s, where I differ from, for example, the Austrian school. They kind of think we're there now, that this next, what I call bust next year is kind of that systemic collapse. Because I'm also where I'm also contrary, is I am believing that inflation has peaked and will, or inflation peaked several years ago, but a couple of years ago, but this most recent run up in inflation, I think, is going to roll over very soon. I think we are overestimating all the focus on all the negativity on bonds, all the focus on yields going higher, inflation going higher. I think is wrongheaded. I think Drunken Miller is wrong, and it won't be the first time with him. He'll tell you that. And I think we are. In fact, I think what Bessent did last week, and he's receiving a lot of skepticism and criticism for what he announced. I think he set the bottom. I think we were going to see a reversal either way, but I think his announcement pretty much coincided with the reversal. So he may have speeded up a little bit, not much. And I do think the bond market is beginning what I think will be a very big bull market to lower yields than we saw in 2020, 21. So we got down to 40 basis points on the 10-year. I think this time we'll get down to zero. Not all for good reason. I think we're heading into a global bust next year. But I think, the start to the bond bull market will be gradual. But next year it'll speed up, and ultimately you're going to see a big fall in rates, big rise in bonds.
But from a macro perspective, just out of interest, who do you think will be the driver of that? Because I can't see that being foreign central banks.
Oh, it's going to be all central banks. If you get a global bust, which I think I describe it as likely that we'll see in October 2008, we all remember the talk that GE Credit was about to go under, which means GE was about to go under.
Well, there were no planes flying because AIG was
frozen.
on the precipice.
So I believe this time around, that was pulling us back from the cliff. This time around, because of the massive leverage in the system, both on the debt side and on the derivative side, I believe this time we go over that cliff, or at least it looks like we're going over that cliff. It will trigger a deer in headlights moment where every central bank will be flooding the system with money because we don't have anything else that can move fast enough to stop a free fall in the global financial system. So that's what I think will trigger it. I've said, and you guys have heard this before, I think, on podcasts I've spoken with you guys about, we could see 20 trillion in new QE, maybe more, coming out of the Fed, and probably 50 trillion globally out of the central banks in terms of new money printing. What is it that money printing is? It's you're basically buying every treasury bond, at least for the Fed, every treasury bond in sight, every government bond in sight, and crediting the bank with money. So that's what I think we'll see. I'm not, as I say over and over, I'm not endorsing this. I'm saying this is the inevitable result of what's coming, of what we've done over decades.
So I think you're kind of agreeing with each other about what will happen, but just at different times.
I think it really comes down to timing. The issue is timing, how close we are. Because the analogy I make with this is, and it's not a perfect one, but it's impossible to forecast the precise point at which a market fails. But what I think we can perhaps collectively do is identify when. So imagine, say, snow settling on a cliff. You can't tell which snowflake is going to cause the avalanche. What you can do is determine whether the snow mass has shifted from being in stable equilibrium to unstable equilibrium. And we are now facing unstable equilibrium in the bond markets and probably all other markets as well.
Well,
it sounds like, I think what you're proposing or suggesting is what the Austrians are suggesting, which is this is that time down where the dollar.
I mean, Mises called it the crack-up boom, where people rush to invest in anything by way of real assets as opposed to, say, paper.
Yep, and I've for a long time said the next cycle that there are a lot of people that are linear here that think, okay, we're in the commodity boom, and they start pushing numbers out there, and I say we're going to have a run here into the top, and I think the top in the market and the economy is probably this year, but it doesn't have to be, could be months away, but that the real commodity boom comes as a result of all that money printing next cycle. So silver can fall from 200 back to you could fall 75% back to 50. And run from 50 to 1,000 is what I expect to see in the early 2030s. So this is not that end of financial system event that the Austrian Great Reset, whatever people want to call it, because of the printing press and because I believe next year is deflationary bust. If we go into a bust, we're going into deflation. That gives central banks infinite ability to print money. So there's one more cycle. The difference between myself and the Austrians, maybe myself and you, I'm not sure, is, as you say, timing. I think we have one more cycle simply because as long as they have the printing press, they can kick the can down the road one more time. It's going to be nasty. I'm calling for an 80% bear market next year. But we come out of that I think we put in a secular top in markets this year, secular top in the stock market this year, wherever it goes. I mean, my target right now is 10,000 on the S&P, but wherever it goes, a secular top, which means the next cycle we fall far short of that. But if you go down 80%, let's say it's 10,000 to 2,000, you could quadruple and get back to 8,000 and still be well short of this cycle's top. So I think we're making a secular top, which means the whole long cycle, going back post Great Depression, is in its last stage. It's just that we have one more cycle. So, as I say, I think it's the mid 2030s where all of this comes to an end, and where who can predict what that end is? But it's going to be a collapse. It's the end of the Ponzi scheme that's been in place for 80 or 90 years.
So the cycle started August 1982, I think you said, and
Yep.
we're coming to the end of that. And you coined the phrase "melt up" in 2019, which nobody was saying. And obviously, given how price action has moved so aggressively, people are starting to adopt that term. But you were the originator of it, and I think you've been very clear in your in our podcasts and with others that you see things as kind of pre-bust, bust, and post-bust. So that's why I think you both are actually talking about the same events, but just it's a question of what happens, government response, then what happens after that as to how this plays out. And obviously nobody knows anything 100%, but you've been pretty much on the money so far. So it's going to be...
Not to quibble, but and it's not with Tim, because I'm not really sure whether he agrees with the Austrians, but I'll use a Peter Schiff type. Their view is that a collapse is imminent. Yeah. And it's a huge difference as to whether the collapse is this cycle or the collapse is after the next cycle. So it can, because I argue that because there's a lot of people out on social media that don't understand the difference. I mean, you can drive a truck through whether, you go down this time and it's over, or whether because of printing press, you have one more big cycle, particularly in commodities, where you can make the kind of money you made this cycle. And then, who knows, I could be off by five years or more, but my estimate is right now, mid 30s, you're going to have 25% inflation in this country, in the U.S., probably. Interest rates in the high double digits, T-bills probably over 20 and long bond maybe approaching 20. And there's no way with the massive debt that we have in the system, because this will be repeated around the world, there's no way you can fund all that debt. We can't service it at 5%. How do we service it at 10 or 15, whatever? So Tim and I think agree exactly on the underlying problem and where we're headed. But, that 6 or 7 or 8 years before it actually collapses, there's a period in there where gold goes to 20,000, from if it's 7,000 this cycle. Like I said, silver could go back to 50 and then go from 50 to 1,000. Gold could go back to 3,500 and go from 3,500 to 20,000. And I'm not sure those numbers are accurate given how much money gets printed. So that's my only point, is there is one more cycle that's going to be very different than this cycle, and the leadership in it is going to be very different, but it is going to be a big cycle.
So what do you see as being the solution when we get to the sort of the end of empire moment? What do you see as being the solution, or the next stage of the monetary system? Because that's something I'm not clever enough to work out. But we've had an unbacked fiat system now going back to the early 70s, which has never happened before in history, and some would argue it's unprecedented and it's reaching the end of its shelf life. Whether or not that's the case, and we can obviously debate the timing, but on the basis that it is going to be replaced, what do you think it will be replaced with?
Yeah, so the Austrians would say reset. You go back to a hard money system, I'd love to believe that happens. I have said for a long time, in the kind of unwind that I foresee, which is a global unwind where I couldn't even begin to guess. I fear we're going to have anarchy. I fear that we're going to have totalitarianism come out of that. I really, I just have no idea because, I mean, next year's bust, if I'm right, the next year is a bust. It's going to be very uncomfortable and cause a lot of dislocation. The total collapse of a system, with all that's gone, off the rails in the last couple of decades, and particularly the last decade, I fear, I fear certainly in this country, I fear for our, I'm 74, so I may not be around, but I fear for our kids and our grandkids. I mean, it's really going to get ugly, I think.
So,
Keep in not to interrupt, but keep in mind, and again, I can speak from the U.S. standpoint, but I think it is certainly true in the U.K. and elsewhere. There's so much dependence on the government, and there's such an assumption that the government can always step in and provide the support system when we need it. If you're talking the kind of interest rates and inflation I'm talking about, there's there's not enough money to service the debt. Never mind have a welfare system. Never mind have a Social Security and Medicare system. Never mind have a Medicaid system, or food stamps or anything else. With such a big percentage here and an even bigger percentage in your country of people dependent on government support, think about the ramifications for that. I mean, we're talking about, you know, nobody's going to buy our debt at some point. Well, before that, it shuts off the money printing system. I would say, 4 or 5 years into the next cycle, maybe sooner, we've lost the printing press. Both
I think
here
in terms
and
of
abroad.
social cohesion, we're ahead of you for once. I always used to think that the states led the way, but I think in terms of the controlled demolition of the UK society and culture and economy, for once we're ahead of the states. I mean, there's a widespread feeling here that the UK government is no longer responding to the needs of the electorate. It's pursuing its own warped agenda, and everybody hates it.
Yeah, well, look at ours. I mean, you can like or dislike Donald Trump and some of his methods,
But he's
but
taken control of the borders in a way that we haven't been able to do.
and look what he's uncovered, because it's pretty clear now. I think that for years we heard the Republicrats, or it's
The
a
uniparty.
unified one party system.
Yeah.
And he's uncovered that. That's what we have here is a government that's only out there for themselves. I mean, our and there are exceptions, of course, but basically our elected officials are, filling their pockets at the expense of the rest of us. And he's really uncovered that, just like he uncovered the media in terms of its biases, by using the term fake news and all of that seemed crass when it was started. But I think a lot of people who should have woken up a long time ago are finally awake.
So looking at the economy, I think you've said that you're seeing it deteriorate, which is why you feel that we're in a deflationary period, or there's underlying deflation, which
We're headed for deflation. We're not there yet.
We're not there, obviously. Yeah. So Trueflation is a very interesting website that shows inflation to be much lower, and I can't square the circle on
Lower or higher?
No, much lower. So it's I can't square the circle on this, whereby what we're seeing and what we're expecting is base metals, precious metals, all to rise,
hard assets.
all hard assets to rally, equities to rally. You'd expect the central bank to respond by cooling the economy, by raising interest rates. The bond market, the 10-year, the 30-year, the 3 and the 2 is still actually pointing higher. Look technically like they're going to break out. what am I missing in this picture? Why? I know you've just said that, and I can completely understand when you look at the figures, because because oil rallied aggressively, because these markets rallied very aggressively, the inflation numbers are based on change, and if it like stays at a high level, then it will effectively not look like it's changed much. So the numbers are going to start to look good into the future, which will allow, so it's going to let Kevin Walsh potentially get his his view on lowering interest rates. I think he's speaking this week, which could be an important event for the markets. But I just wondered if you could explain how we can get such a big run in commodities and yet the long end of the bond market not respond negatively to that, anticipating inflation.
Yeah. So, because I am looking for $9 copper, in the next several months.
That's up from 7,
raise
right?
that.
Was that
so? Copper, I think, is 6.5 now.
Yeah.
So that's a big jump too. So yeah, you're right, and lots of other metals and commodities are moving up. I do think inflation is peaking here. Overall, commodities probably not, but I think inflation overall is rolling over. And one of the big keys, and again, it's probably a contrary call right now, but I see oil back into the 60s very shortly.
Yeah, I was going to ask about that. Yeah.
So I really do think we're closer to the end in Iran. I don't know how it's all going to get resolved, or whether we're going to have an agreement, or more conflict or what. But I do think we're solving the oil equation, and yet what you've got out there, from oil companies to Wall Street to all the pundits, everybody wants to give you this argument that oil's going to 150, or that that we're really in an oil short situation that's going to get a lot worse this winter. I think we're going to be surprised here that what went into the Iran war was a glut of oil that nobody saw. I was one of the few real bears on oil for a couple of years after Ukraine. And
you said it on our show.
People finally came around and said, "Wow, there's a real glut of oil. We didn't realize how much supply there was out there, and the demand is not nearly matching it." I think we're going to be back in that position here a lot sooner than people realize. Oil is getting through the strait, et cetera. And we're certainly pumping oil out of this country. So I think oil's one of the keys. The other key for gold and silver is the dollar. Again, Tim was right. If you are looking at gold from a standpoint of another currency, it's not going to look as good as it's going to look in U.S. terms. It's going to be very much about the weakness in the dollar, and that's true. If you look at charts on gold over time, it really differs. It really matters what currency you're pricing it in.
But it's tended to rally in every currency though over the long run.
Oh, it's
since 2000.
Yes, yes, but in terms of the shorter term, the currency does matter in terms of that. Yeah, definitely. And I'm certainly a huge pull on gold over the next several years in all currencies. So I'm not trying to make that point.
Because the strange thing is, when I think there's a degree of money illusion going on for people when they look at, for example, they assume they have. I mean, the UK British people are obsessed with property. I can't speak for Americans because I don't live in America, but certainly we've had a cult of property ownership for as long as I can remember. Property in gold terms has gone nowhere. Property in sterling terms has done very, very well, but that's not real wealth as expressed in a hard currency.
Yep. Yeah, it's probably somewhat true here. Definitely, real estate for a long time was, most people's biggest asset, and obviously people had a big run in real estate over many decades. So people believe in it. I think that's coming to an end too.
To go back to something you said earlier, there was a headline in the Telegraph newspaper yesterday, I think, in the UK, said that the graduate opportunities for UK students are as bad as they've ever been in history. In other words, the jobs available have collapsed, and I suspect this is probably something close to the case in the States as well. This is a disaster if you're leaving university or leaving school. there just aren't the jobs, and the jobs that are there are probably going to be quite poorly paid ones. This is, there's lucky generations and unlucky generations. This current graduating class is a very unlucky generation.
Yeah, what's becoming a pretty much accepted story over here is that you really can't justify the cost of a college education for most people today. That many people would be better off going to trade school or learning a skill. And frankly, if you look at what's coming in the next cycle, based at least on my view, um, there's going to be real need for more of the trades type people, electricians and plumbers, and people that can build. We're still reshoring. We obviously have all the build out on the AI. There's going to be a lot of construction jobs out there. Mining's going to need people that can work in the mining industry, and it's going to be a lot less of social workers and financiers and people like that.
Sociologists.
Yeah, exactly. So I definitely I think that trend is absolutely the same here.
So
What advice are you giving your kids? What
frankly,
advice are you giving your kids, Paul?
pardon me?
I know Tim's just asking what advice I'm giving my kids. Well, they're not interested in the markets as yet, but they will be. So I was going to actually.
You may not be interested in the markets, but the markets will be interested in you.
Well, exactly. It's all about timing when you get them interested, because of course it's very hard to teach them because they think they know everything or are not interested. That's kind of, they have their own interests. But I was going to ask Dave about mentorship perhaps a bit later. I wanted to talk about AI, like given this AI revolution that's coming at this point, and obviously we've seen some big moves. You were really bullish, even during the big runs. You were continuing to be bullish on it. I think you called, what was it? SMH was at 353 in November, and you said you're looking for at least 40%. I mean, it went up 90%. Is that move over?
I had a target, I think, of 600 when I was down there.
Yeah.
And I've raised that target to 800 on SMH.
Right. Wow.
So I am not in the camp that says it's topped.
That's incredible. They're absolutely incredible calls. I mean, at this stage, to say that there's more to come is quite something. And now, I mean, I have to interrogate how you're making that kind of call. Is that the cross-market analysis that you do, all the pieces of the puzzle kind of fitting together to say that there's going to be cheaper money, weaker dollar, more risk on? This hasn't played out yet, and the market's still interested in it and not fully invested? Because it certainly feels to me like it's so hot that how could it go higher?
Yeah, in the case of the semis, a lot of it is obviously the memory story. Having lived through several cycles, semi-cycles, and knowing when they print money, because it is a commodity that and it has huge multiplication factor on that chip. That in memory, when I realized how short in supply we were for the demand, I just said, there's and the fact that we have so many things going on. You have the whole Taiwan situation, which means you got to build out semiconductor elsewhere, right? You can't assume that we're going to have access to Taiwan forever. So there's building of equipment here. So the semi-equipment area had unlimited demand for, as far as the eye could see, at least the next 2 or 3 years. Micron and the whole memory situation. And I've lived through them, so I know what double ordering does. And I know when things get frothy, all of a sudden you get surprised by the fact that a lot of those orders get canceled. So I was considering that, but you just, when you looked at the whole AI demand situation, it was like even if there's double ordering stuff, this thing is just nowhere near done yet. I'm not sure I buy into the whole, there's no problem until 2 or 3 years out. I think the problem, I think the top is coming, but the fact that they can print money, I mean, just look at what Micron's earnings have done. It just told me there's legs here, and then of course I'm looking at cross markets and markets in general and everything else. So I don't pretend to think I'm going to hit it just right, but as far as I'm concerned, there's still plenty of upside, and I get, when you get these sharp corrections like you're getting in semis right now, I get people wanting to call a top, and I also get the risk that I'm going to be wrong at some point, or could be wrong at some point, where it doesn't come back. But this time, to me, it looks like I feel pretty comfortable saying this isn't that. We haven't seen the top yet.
I've heard a lot of people say that the AI companies aren't making any money; they're just losing money, and the general view is just very skeptical. And it's, as much as I like to be contrarian, it seems to be the case. There was this huge kind of everyone falling in love with AI, and then realizing actually there's certain things it just can't do as well as a human. We're just not there yet, but it has potential. It feels like very early internet where it was.
They're losing money on every sale, but making up for it in volume.
Where have we heard that before?
Yeah. So those arguments seem quite persuasive, but it's really interesting to hear that actually the market is just going to power through.
But it's tricky because I'm in that camp. I do think AI is going to be part of the bust. I mean, we are seeing the emotions are taking over in AI, certainly, the way they're spending money like drunken sailors, et cetera. And I get that it's a compelling story that this thing is in its infancy and it's going to be huge. So you're nowhere near that.
Do you think this is a reflection of corporate executives, senior executives, management in that sector, in the tech sector, just jumping over the cliff together? That it's a massive example of a massive failure of groupthink?
Yeah, it's greed and fear. I mean, they're in a great, they're in a sweet spot where everything looks great, and when they start looking at, because they all have their projections and stuff, that when they start, the whole case being made that this thing is in its infancy and that AI is gonna, we're nowhere near even the third inning. They all, it's partly groupthink, it's partly greed and fear, and it's partly, I think, fear of missing out. It's like, well, all my compatriots are doing it, I got to do it too, or we're going to be left behind. I mean, that's a little bit of the fear I have in terms of what's going on with AI, just from a social standpoint. Is the argument we hear, pushed by certainly the administration, but also a lot of others in the industry, is we got to do this because if we don't, China will take the lead. China will have the industry.
That argument becomes less compelling when you start losing your job, though.
Yeah, well, no, I think it's dangerous, but I'm just saying right now that's a lot of what's driving this is, if I don't do it, then I'm going to be left behind, and ultimately that's how we get tulip bulb tops. That's how markets come to ends. I don't think this is any different.
Aside from gold, if we said, Dave, you can't invest in gold, what currencies would you then rank if indeed you do look at them like that?
Yeah, well, of course, I'm looking at it cycle to cycle. So I'll answer it this way, I guess, which is that yes, I'm really bearish on the dollar shorter term, meaning the next 6 or 9 months. But I do think somewhere in the bust, not initially, but somewhere in the second half of the bust, the dollar will, and not because it's a good thing or that it's a rational move, but the dollar will, as it always has been, I think it's not going to change this cycle, will become the flight to safety trade. So I do think you could go from the low 80s, low to mid 80s, 82, 3, 4. You could go from there to 120 on the dollar simply because of how bad the bust is and how, everybody's going to be saying, where do we go?
They'll be buying treasuries, won't they? Like hand over fist.
They'll be buying, and that's it. They'll be buying treasury. I think treasuries will be maybe the top asset out there. As bad as the underlying financials are, at least in the for the time being, it's going to be, this is the safest. This is the cleanest dirty shirt in laundry type of thing. And so I think you'll have a very strong bond market and a very strong dollar. It might only last. I think the top in the dollar might be early 2028. I don't know. But I could be, as I have been on the markets. It gets stretched out, and I could be way early. But and then I think the dollar, you know, over the next cycle, because of high inflation, because of all of a sudden realizing, hey, they can't finance their debt either. Who wants their debt? Over time, I think, and for lots of other reasons, maybe some of them to do with what BRICS are trying to do, et cetera. But ultimately, I think the dollar can fall below 50 next, probably in the 2030s. But gradually go from 120 plus down there over the course of the next cycle. So I'm not a long-term bull on the dollar, but I do realize there's maybe one more, shot at higher levels. Um, and who knows? Swiss franc maybe. I don't even forecast Swiss franc, but you could see some of those things get some bids. Um, and short term, while the dollar's going down, I think the euro can go to one. I have a 130 and have had a 130 target versus the dollar for a long time. I think I'm going to be low, meaning that between now and 6 to 9 months from now, you could see the euro 135 maybe, and the pound. I have a 150 target there in that same time frame. When the dollar's going to 82.3, I think that's going to prove low, and maybe it goes to 160 or something. And then they're basically the paired trade, the opposite of what the dollar does. So when the dollar rises, they get hit hard. I think the Canadian dollar, Kansas, being run terribly, by Carney, and they've got all kinds of
One of our
problems.
more successful exports.
Yes, yeah, you guys are lucky. um, Japan's a wild card out there.
I
Um,
was just going to ask about Japan. Do you have? I mean, no mention of bonds or currencies can be complete without a reference to the Japanese market, which is just weird as anything. Do you
yeah,
have a
I
view
mean,
on the sustainability of Japanese debt or the yen?
yeah, I don't think monetary theory has been ruled extinct, and Japan for 2 decades has kind of defied logic, and
They are different from us, though. I mean,
well, they're more
the
they're definitely
scariest thing
homogeneous.
the scariest thing I ever heard, which is going back nearly 30 years now, was a Japanese film manager that said that Japan had been the dress rehearsal and the rest of the world would be the main event. And that just feels like it's becoming increasingly true because we're all sort of slowly following into the same deflationary pit,
Yeah,
potentially.
but what I think I was thinking you're going somewhere else, which is we're all following in their footsteps in terms of the monetizing of this, and thinking
Sure,
we,
sure,
thinking
absolutely.
that we have a secret formula that can work. It doesn't,
Those guys were stupid, but they weren't stupid. They were just ahead of the rest of the world.
Yeah, and frankly, now they're going to pay the piper because I think that game has come to an end. In their case, it took 20 or 30 years. In our case, it's going to happen in a decade. But, the printing of money and the after effect of that. So there's no, you know, magic bullet that they've been able to figure out. Ultimately, rates and inflation are starting to move up there, and they've monetized to such an extent. They're tremendously leveraged to that, and so they're going to see. I think what I'm predicting we're going to see, out late this decade, early next, where when rates start really moving up and they can't finance, all that they've done.
There was a
Um,
tremendous letter to the FT 20 years ago or so from a Japanese gentleman. He said basically the Japanese weren't stupid. They were just basically ahead of the rest of the world. He said the bottom line was that once you've suffered a catastrophic stock market and property market boom and bust, There is no alternative, but in his words, years of economic indignity. I thought it was a fantastically Japanese phrase.
Yep. They're not gonna like it, I don't think. Um, so so going into the bust, I can't even predict what what exactly triggers it, or um, you know what the candidates are that are going to be the big player. But I think Japan is certainly out there as one of the very likely things that could, um,
But
you know,
the reason Japan's
turn a
such a
normal
fascinating the
recession into
reason
something
Japan's
much
such a
worse.
fascinating outlier is that Japan had this massive economic turbulence, but they had social order throughout all of that. There wasn't rioting, there wasn't blood in the streets. If the US or the statistic I still cite on this, and I hope it's true, is that after 89, after their markets crashed in 89, the Japanese economy suffered basically between stock exchange valuations and property valuations. They suffered a cumulative loss of wealth equivalent to two American Great Depressions. And the difference being they were stoic while they handled it in a way
Yep,
that the West will not be stoic when the West has to handle the same situation.
yep, yeah. They kind of buckled down and said, "What can we do?" I see us being all over the place when that happens, and you know,
Everything will be on fire by then.
yep,
So,
yeah. I think that's true.
so we've got your S&P target of 10,000. We haven't got your Dow and your Russell targets. What are you
Yeah.
looking for there?
So my Dow target is now 70,000.
Right.
My Nasdaq target
Oh yeah.
is 36,000. My Russell target is 4,000. And so if I haven't done numbers recently, but I think if you do it, it's somewhere between 25 and 30% for most of that, maybe a little more for the Russell. Um, but yeah, because we're at 3,000 basically in the Russell, so it's 33%. Um, so I think and I think you can get there before the end of this year, maybe even before the elections. Um, so again, people pin me down on that, and I go, those are best guesses. That's not a
Yeah.
forecast. I just am saying if we get into this parabolic, you can cover a lot of ground in a hurry. It doesn't matter whether it finishes in December, October, November, or January, February. No, it doesn't matter. But I think it could be this year for sure.
I find it interesting that some people are kind of deaf to your bullish calls and just focus on the fact that you are kind of playing chess a few moves ahead and looking at the fact that there's going to be a melt up and then a collapse, and they just focus on the fact that you are talking about a collapse and then saying that you're wrong because it hasn't happened. And I find it, like people have said to me, oh yeah, he's always bearish. I was, no, he's not. He is bearish, but I've never heard him once make a bearish, like near-term call. In fact, on all the kind of panics that have happened when the markets pull back, say on the tariffs or any other situation, Iran war, whatever kind of risk-off situations happened, I've just heard you like doubling down and going, no, I'm even more bullish now.
The truth is, from March of 2020, there has not been a more bullish. Nobody's even close to being as bullish as I have consistently been for that entire time. Now, I did at the end of 21 say we could have a correction, that the market, too many people are now getting bullish. I didn't see a bear market. I thought it was going to be like 10%, but then we had Ukraine happen and it went further. Um, and from October of 2022, I've by far been way more bullish than anybody else, and consistently with conviction. Not once have I ever wavered and said we're close to rolling over or this coming to an end. So what confuses them is, as I have one guy out there who's um, has quips, and he calls me the most bearish bull on the street or most bullish bear on the street, because I've got the high on in terms of my extreme forecast on the upside, but I also talk about the global bust all the time. So, but people don't understand. And I'm a big picture macro guy, and I've developed skills through my 53 years to look out farther than most people and not get it right timing wise, but understand the kind of step by step where we're headed. So I don't, I'm not sitting there saying, well, I don't know if we'll see a bust after this. There's so much in place that says when we go down, we're going down big. It's the leverage more than anything. I could be proven wrong, but this idea that when you mention the bust back in 2020, that means you were predicting a bust to happen then. Now, I do cause my own problems too, because I'll put out guesses and say, well, we could see the top in the next 6 or 9 months, and a bust will follow that. So they'll say, yeah, well, you were calling a bust back in 22 or 21 or whatever. But I never came to the point of saying, yeah, that's in place now. I've always been really bullish.
And I think that's absolutely crucial because, as I say, I've always took it as we are still going up, but this is inevitable, but we are going up now. So, but it's just what people tend to focus on, especially with
I don't
retail.
understand the confusion, except that a lot of the criticism comes from traders who don't look out very far, so they only hear what they hear in the short term. But I'm somebody who doesn't, unless I see something that causes me to. I typically give very unhedged views. I mean, so there should be no confusion because I'm pretty clear of how bullish I am whenever I give a forecast.
Well, that's what I thought. I thought it was pretty straightforward. And whenever I've seen the market come off, I've jumped into a video that you might have put out because you are regularly out on X and on videos, and he's never once called the market down in the short term. And I think
this is an issue with human nature. People hear what they want to hear.
Yeah, and
they don't hear what they want to hear.
Yeah, and I suppose late into moves like, say, with the gold and silver trade that we were talking about, that's probably when they jump in and then get frustrated. But that's markets
for sure.
It?
They want somebody to blame if they they forget I was telling you get in at 20 or 25 on silver, and I'm to blame for them jumping in at 100 and then now facing and a lot of them are playing with leverage, either options or margin, and then get forced out and take losses and say, I did that because of you.
Yeah, absolutely. So how far back do you? I mean, obviously you've been doing this for 53 years. You are technically retired, although you seem very busy for someone who's retired.
Yeah, I'd probably spend more time on this now than I did when I was. I for my first half of my career, I was a money manager. Started in banks, managed money there, but then was at Textron running their in-house equity pension fund, and that's really where I kind of built my career because I had top 1 percentile numbers for 5 years running. They were an anti-equity shop, had pulled all their money out after the '74 crash. G. William Miller, who went on to be Jimmy Carter's Fed chairman, was chairman at Textron before I arrived there. And in 1974, after the Nifty 50 crash, it was the worst stock market post Great Depression up to that date. He said, I never want to go back. And back then, the New York banks managed most of the corporate pension funds in the country, pension money in the country. So they all went to the same dinners and lunches and all that, the same Nifty 50 stocks. It was the one decision stocks, the big blue chips in the U.S. That was the story back then. And so you never have to sell them because they're, this is what drives America. So those General
Motors, sell them because
the
margin calls will sell them for you.
Yep. So IBM, General Motors, Merck, et cetera. And then '74 hit and they went down. The market dropped dropped in half almost. And he said, I never want to go back to my employees and particularly all my group VPs are close to retirement and tell them that their pension fund has been cut in half. So he pulled all the money out of New York City, New York money center banks, brought them in-house. Textron was the first conglomerate, and ran the pension fund like they did the company. So they had mostly private placements and fixed income. And they had a little bit in equity. 10% of their assets were in-house pension fund was in equities. And then the oil market took off in the late 70s, early 1980, and they dropped from a top quartile. They were doing well, doing it in house, but they dropped from a top quartile performer to 50 percentile. They said, maybe we do need more public. We need somebody to do the public equity because they just had somebody that was doing the private stuff, doing the equity. So they owned. When I got in there, they had a handful of stocks, and they were mostly things that were almost private equity themselves. Anchor Hocking was a glass making company. It didn't have big float. So they had public companies, but they weren't mainstream public companies typically. So they said, we probably need somebody to be brought in here to opportunistically put in, increase our equity ownership when the time is right, and then get back, lower it again. So I was told, I answered the search, and I had guys that were covering me on the street at the time. I was in a bank saying, you don't want to go there. It's a dead end equity shop, dead end for an equity investor. Don't go there. But I was in a bank. I said, this is a chance for me to actually build a track record. And I was 30 years old. But I was pretty confident. I came out right out of college and started working in the investment department. So I said, I think I can show them how to do it conservatively. I went in there. They had a $500 million portfolio, 50 million in equities. And by the time I left 5 years later, and the whole time I was there, G. William Miller had left. So when I came, he wasn't chairman anymore. He'd gone to Federal Reserve Boston and Fed chairmanship. But the chairman and the president and all the group VPs that were on the investment committee would say, Bill says we should never do this. I had to answer every meeting to the ghost of Bill Miller, G. William Miller. And but I came in there in December of 81 and said, we'll build we'll build an equity list, keep your powder dry. We're in a bear market. August of 1982, which is why I know that was the bottom. I went to the investment committee and said, it's time. And of course, they had 50 million in equities. I asked for 100. They gave me 50, and I came out of there as this 30-year-old kid, kind of upset. My boss was going, who was a good guy. He was probably 10 years older than I was, but he was head of the investment department. And he goes, you don't know how big that was. Relax. We'll do it a little at a time. So, long story short, I took them from 50 million equities to 500 million out of $1 billion portfolio when I left. And I did it mostly because I had top 1 percentile performance most of the way. And I recognized in 1982 that inflation was peaking, and that you don't own inflation based on what's happening now, or own stocks based on what's happening now. You look ahead, and even it was before the word disinflation was invented, but it basically said we got to own disinflation stocks. So I was buying food companies and drug companies, pharmaceutical companies, and things that were steady growers that had been beat up because inflation went to 20%, and interest rates went to 20%, 15% on long bond. And that was the beginning of the move, the big bond move, the big move in industrials began to move. Some industrials began to move, but it was mostly the slow growing, steady consumer growth stocks. And I own most of my portfolio was in that kind of stuff. So while other people were weighed down by owning energy stocks, they were looking backwards and extrapolating forwards. They owned energy stocks and metal stocks, etc. I was in all the stuff that was out of favor, and I beat the S&P by a lot, and then went from there to Fidelity. So I've spent a lot of my career seeing these kind of big picture trends, and so my first half of my career was a money manager, top down more than bottom up, although I picked my own stocks. And it just was a natural transition from there to, being a macro strategist.
So Tim was asking a question about effectively how to pass information on to the younger people. You're doing it in a way of obviously making your calls, responding to people. But if someone was to say to you, where would you start? Because almost the problem now is that there's too much information out there. It's too easy to get sort of drawn into other people on X who are, making short-term calls but don't have the sort of track record that you do, or to kind of look at, say, AI to make decisions for you, all these other things. We all know it's got to start with a grounding in understanding the markets, and that's not something you can do quickly. That you just need experience. But how else would you kind of recommend that somebody become successful?
Yeah, I came onto X. I retired in 2013, so I came onto X, or Twitter back then, saying,
For some of us, it'll always be Twitter. It'll always be Twitter.
Yeah, me too.
Crap.
When I went on, it was with the idea that I love this business. I love what I do. I think I do it pretty well. I don't want to stop, at least opining on things. I think I can help the little guy, understand that just because you're hearing from so-called Wall Street pros on CNBC or reading it in the Wall Street Journal or what have you, this was really before social media became what it is today, but that, that's not how you make money. And to try to, from my contrary standpoint, try to teach them that sentiment plays a big role in investing, try to teach them some about the markets and about the economy and stuff. And, that's built over the years to where I really feel that's what my calling is, at least, or what I'm doing in my later years is helping the little guy. And particularly, and I had this view probably even, back in those years, that we're coming towards the end of a big cycle, and that at some point, you need to build your nest egg for what's coming. And to try to get people to, I just said, I can't help everybody, and I'm not, but if I can help some people, get enough financial well-being to withstand some of these down periods, I'm doing something good. So that's kind of where I come from, and I get lots of people private messaging me, asking me to be their mentor. And I go, I'm not doing that. I do it in a big picture way on, I can help a lot of people on X, but
you do it for everybody. And
I don't have an interest in doing one-on-one mentoring. And, people just kind of assume that, you're not doing anything. Why don't you help me?
Well, you're doing plenty at the moment. So,
but my, I do get questions on there. You've probably seen some about people saying, what would you tell my son? He's, going, finishing college, or he's in the middle of college. What would you? And I've said, my simplistic view, or my big picture view is, if they're good, first thing I say is do something you love. Don't do something just to make money. Figure out what your aptitude is and what your interests are, and that'll go a long way to make, you'll invest yourself in whatever it is if you really like it. But then secondly, I said, from a standpoint of where we're headed, you probably maybe be a geologist, go to the Colorado School of Mines, and there's a shortage of those kind of things, and there's going to be a big shortage as the metals move up. And I said that, 5 and 6 years ago. So, or go into the trades, don't necessarily do what everybody else is doing. And, trying to get people to look forward, not backwards. If it's from a market standpoint, it's really understand, probably the biggest message I give is the whole thing about sentiment. The psychology, I always recommend the book, Contrarian Investment Strategies by David Dreaman. I read it in, a previous version. It was a different title. it might have been the Psychology of Stock Market or whatever, but I read it in 1977. And I just remember after reading it, because it spoke my language, I was already there, but I said he laid it out so simply and clearly that from that day forward, I said, if I have to recommend a book to any investor or somebody starting out, this is the book I'd recommend, and I've done it ever since. So, again, there's a lot more to investing than just that, but that goes a long way to at least getting people out of that mindset of, following the leader, following the crowd.
So, with regard to being contrarian, do you have a favorite source of like, some people say Jim Cramer, if he says buy, then that's it, and if he says sell, are there any favorite analysts or sources that you just think they're just such great contraindicators?
I used to joke that I had a boss that always was opposite to where I was.
I had one of those.
You're a great contrarian indicator for me, and I do say that to some people on Twitter, or, where there are some people just inevitably when the market's right where I think we're turning, they panic and they're coming in, and sometimes their emotions get the best of them. They're telling me I'm an idiot or I got it wrong this time or whatever. My response is usually you're consistent. You are my most consistent contrary indicator. It's just, I know myself, and that's an important lesson I think for everybody, is know who you are, know your tendencies. I know I'm somebody that is the last one standing when everybody's saying one thing. I'm still willing to, and I don't do it just to be contrary. It's just, everything feels like you're turning here, just like the bond market now. I'm very bullish right now. I think we've bottomed. I could be wrong on the very short term, but it's in my nature to not be bothered by being away from the crowd. Whereas I'd say the most natural, the majority of people need to be or are most comfortable being with the crowd. And that's just not where I'm at. So
it's an evolutionarily learned behavior. We were never meant to be aside from the crowd, because if our ancestors were aside from the crowd, they would have starved to death.
Yep, I think for me anyway, I think it's both somewhat God-given tendency, but also very much it's learned. I've certainly developed my contrariness over the years. It comes with experience, as you know, Tim. It's you just don't have the convictions or the confidence when you start out. You have to kind of see repetitive patterns and in yourself to gain that understanding of yourself and conviction.
Just a final question, because it's so kind of fresh in recent market history with regard to SpaceX. Do you have any particular view on the company and what they're doing? Because obviously it's much fanfare, big rally, collapse back down, seems to be settling. Do you think that's going to be an interesting one post bust, or is it? Or you've not really looked at it that much?
Yeah, I don't know about the short term, which is post bust or pre bust. Post bust, I certainly think Musk is an amazing individual, an amazing, man, smart man that has done an awful lot in his time. What he's created business wise and technology wise and stuff. I certainly think he's there. And you hear so many stories about where we're headed in terms of technology and what's ahead for him or for SpaceX, that I have to say there's a decent chance that this thing is going to go a lot farther than it is now. On the other hand, I was always a value manager, so this is way off my radar in terms of my ability to feel comfortable with the kind of prices you're paying for, future growth that may or may not come. So It's not a stock that I would own in any size in any portfolio in my career, I'm sure. But given the prospects, if somebody said, "Yeah, I'm just putting 1% in my portfolio, and if it goes bust, it goes bust. If it doesn't, it could be a home run." I have no problem with that. I just could never own 3 or 4 or 5% of it in a portfolio just because of the prices. But that's me. I mean, that's just it's not my skill set. Um, and and of course, given my outlook, I think a lot of things are going to get short circuited in the future. On the other hand, it is, when people say what could go wrong in your very negative view of the next decade, um, you know, AI and things like SpaceX could revolutionize the world in ways that I can't foresee. I tend to doubt it. As I say, I think macro is going to trump Trump. I think macro is going to trump pretty much everything, just because we're talking 330, probably 340 trillion in debt now. That probably in the bust grows to something closer to 500 trillion. Um,
Pretty soon you're talking big numbers.
yeah, right. Yeah, we used to, Everett Dirksen used to talk about, talking about millions, and pretty soon you're talking about a billion. Well, now none of us can wrap our head around what $1 trillion is, and we're talking that kind of thing.
Yeah. So, Tim, did you have any final questions at all?
No, nothing to add. I think we've covered pretty much everything I would like to discuss. So no, we're
Brilliant.
good.
I just one final one, if I may, and it's on the stock CRISPR that I don't hear anyone really talk about. And in 2017, I read a report about CRISPR and their gene editing software, or gene editing technology, I should say. Not the company. I was just heard about it and what it would do, and I just thought this is incredible. This is revolutionary, and this could be a kind of an AI type thing where nobody talks about it, nobody says anything about it, and then all of a sudden there's this massive rush. It's not really happened, but I wondered whether that was something that you'd looked into, because I still think there's this nascent technology that is game changing that just doesn't seem to be in the public kind of zeitgeist.
Yeah, I know of CRISPR, but I don't know a lot about the gene splicing, etc. I will say, just in generalities, I mean, we are seeing amazing technologies in so many places, and they could be world changing. I'm not. I'm when you do the profiling, I'm at the opposite end of the spectrum from an innovator. So technology is usually well along by the time I do it. Or understand it. So it's I'm probably not the best guy to talk to about any of that. But I mean, I do think that is one of the. It doesn't play a role in my forecast because I can't. I just don't think it's going to overcome what we face fast enough. But those things are the things that could change the game. When you have a guy like Elon Musk saying money won't matter in 5 years or whatever.
Easy for him to say that.
Yeah, right. I came out on Twitter and said money will always matter. I'm just not in that camp. I think it's pie in the sky to think that somehow, having robots do everything and AI do everything, and we're just going to sit back and enjoy leisure. I think that's doom and gloom as far as I'm concerned. So I don't think we'll ever get there, and I don't think it's healthy, but I also don't think we'll ever get there.
So it's normally about this time we would move to media picks, and I think we should recommend A, the book Bitten, and B, the video that you shared on your channel, for the reasons of A, from our last video, or may have been two before, we discussed the challenges that your daughter had, having got Lyme's disease from a tick bite. I was very alarmed to see recent reports to say that there's certain ticks that are now, if they bite you, you become allergic to meat, which is just frightening and incredible. I just wondered.
That's been around for a while, but it's the Lone Star tick,
Hmm.
which is a little tick with a white dot on its back, is starting to spread. And in the U.S., it was typically down in the South, and it's spreading north now. It's up in New England, certainly. Um, and so Martha's Vineyard supposedly is having a huge red meat allergy problem because the Lone Star tick has gotten there. So, these things are spread by birds, migratory bird patterns, particularly. So,
And
a
probably
lot of
by
this stuff
Bill
is,
Gates as well.
what's that?
Probably by Bill Gates as well.
Yeah, right. Yeah, well, it's funny, and RFK is certainly, I he says he had kids with Lyme, and not short-term Lyme, I'm sure, chronic Lyme. Um, so he was aware of it going in, and he certainly, taking on the medical establishment, the government medical establishment in this country, and I applaud him for that. The CDC, the NIH, and the IDSA, which is the Infectious Diseases of America Society, um, are, the guidelines come from IDSA. They put out the guidelines that most doctors in this country follow, and they carry their weight carries throughout the world for Lyme disease. Um, they've been terribly behind, and it's a kind way of saying they've been basically lying and covering up about Lyme disease for decades. I came into this in 2000. My daughter was in eighth grade and got diagnosed, and I thought, oh, good, it's just Lyme disease. A few weeks antibiotics, she'll be good as new. She missed high school, etc. Um, it's a horrible disease if not caught early and treated properly, and the IDSA's guidelines are part of the reason people don't get treated properly. They have um, a recommendation in there that if you get bit, let's say you're gardening over the weekend, you get bit, you go into your doctor on Monday or Tuesday, and you have a bullseye rash, which is a telltale sign that you have Lyme disease. It's more diagnostic than any blood test. If you have that, you have Lyme. That bullseye rash, um, they will say, "Oh, we can give you 2 doxycycline pills, and that'll take care of it because you caught it very early." That is the worst thing you can do because um, 2 pills doesn't get rid of Lyme disease, but 2 pills will send a signal to your immune system saying, "We got this. You don't have to produce antibodies to fight this. We're treating it." And so it number one, it shuts down your immune system in fighting it, and number two, our blood tests to test for Lyme are antibody tests. So you're not going to have the antibodies to Lyme, and so you're going to get a negative test. You may get a negative test anyway because the tests aren't very good, but that ensures that you're going to get a negative test. So our medical authorities are, and I don't think it's by mistake, are putting out very bad misinformation and have been for decades.
What should you do if you get bitten?
Well, there's what we call a Lyme literate community of doctors out there. And these are the guys in the trenches that are specialists in this. As I say, if you have cancer, you don't expect your general practitioner to treat your cancer. You go to an oncologist, right? You go to a specialist. If you have heart disease, you go to a cardiologist. If you have Lyme disease, you go to a Lyme literate doctor. And they can be Lyme literate MDs or Lyme literate naturopaths, etc. But somebody who is those practices get taken over treating Lyme patients because they have the ones that find out about them beat a path to their door because the medical establishment isn't properly treating them, and they get sick and they keep looking for answers, and these are the guys that have the answers. So um, the Lyme literate doctor community would probably tell you to treat for a very minimum of 3 weeks, but probably a minimum of a month up to 6 weeks or 2 months to ensure that you knock it out. If you get Lyme early, you catch it early, get treated, get diagnosed properly and treated properly, you won't have the horror stories of chronic illness. Um, Typically. the problem exists. As I used to say, I gave probably 50 lectures on Lyme around, mostly in New Hampshire, trying to spread awareness. But I used to say, you can be lucky enough to know you got bit, get a bullseye rash, or get tested properly, know you have Lyme, and get diagnosed and treated early, and then be unlucky enough that that treatment was inadequate and still end up in the horrors of chronic Lyme disease. It is a devastating disease that is, if people knew all the diseases it causes, we would be tackling this like the Manhattan Project, because it is responsible for an awful lot of MS. Fibromyalgia is just misdiagnosed Lyme, and I say Lyme, but it's really tick-borne disease because it can be Lyme plus other things. Um, but fibromyalgia, chronic fatigue syndrome, chronic fatigue syndrome is typically undiagnosed Lyme. Lupus can be a very large percentage can be undiagnosed Lyme. ALS can be undiagnosed Lyme.
Wow.
Bartonella, Parkinson's can come from this. I'm not saying all of it, but a lot of it. Um, you've probably heard about PANS and PANDAS, which is, I'm not sure what that stands for, but it's an autoimmune situation where, after strep, your body the strep gets into an autoimmune situation.
Mm.
You can have some real neuropsych issues and things. A lot of times, PANDAS is related to strep. I can't remember each of those. It's an acronym for the name of it, but PANS is typically Lyme is the cause rather than strep, so it can be it can cause those autoimmune issues, Sjogren's, all kinds of arthritis. A lot of arthritis can come out of Lyme. So we're seeing even things like, all these hip replacements and knee replacements. I would bet you in this country certainly a pretty significant percentage of those are underlying infection from tick-borne disease. Hips would typically be Bartonella, which is, uh, otherwise known as cat scratch disease. So you can get Bartonella from a cat scratch, particularly a feral cat. A lot of feral cats carry it. Um, but there's a tick-borne version of it that can cause all kinds of neuropsych issues and bone issues. Lyme attacks the joints, whereas, Bartonella attacks the bones. So hips and shins and, anyway, neck, things like that. Bartonella, whereas Lyme is the knees and the elbows, more joint wrists, things like that. I got really good because I ran a support group from 2004 to today. I got really good about separating out symptoms that are Lyme symptoms versus symptoms that are Bartonella symptoms. They overlap, but there are some significant differences. And symptoms of Babesia, which is a malaria-like, parasite that comes in through the tick bite and gets treated with malaria type drugs. But they all can look different. If you understand the symptoms, you can kind of diagnose it clinically. And that's what a lot of the Lyme doctors do, is because tests don't always pick it up. The Lyme doctors are able to say, oh, you have symptoms of Babesia, we'll treat Babesia as well as Lyme, or what have you. So it's a I mean, if it weren't so debilitating, it's a fascinating area of study. But the thing is, the medical schools spend 5 minutes on Lyme disease or tick-borne disease, and they're told all this misinformation from the agencies they trust, the CDC and the NIH and the IDSA, so that if you go into your general practitioner, chances are you're talking about somebody who really has very little understanding. Some have learned on their own a little bit, but it's a very complex illness with 95% of the doctors knowing very little about it.
How is your daughter now?
She still deals with it. She's got three healthy boys and hikes 4,000 footers here in New Hampshire, and,
That's good.
kayaks, and, tries to stay active and keep her boys active, and her husband active. um, but she still deals with the fatigue of it. Yeah, if she got COVID along the way, as many people did, and in a case of somebody who's still got Lyme in their system, the immune system just kind of another thing on top of that. So long COVID, you've heard of long COVID. I believe a lot of long COVID is just reactivated Lyme disease or Lyme plus co-infection disease. So when she gets hit, if one of her boys brings home something from school, they might be, sick for a day or two, and she's flat on her back for a week,
Oh, wow.
oftentimes. So
Yeah.
she still deals with it, but generally she's living as normal life as she can.
Oh, that's good to hear. That's good to
Yeah.
hear. Yeah. So, Dave, just to remind everyone where they can find you. I know when you first came on, I think you had about 275,000 followers on Twitter. I think you're over 400,000. Maybe next time when you come on, you'll have over 500.
Yeah, I think I'm 450 something now.
Oh, wow.
So.
Okay. So should be well past that. So I'm going to put on the video your handle, but not everyone listens watches the video. So for those who are listening, give us your handle.
Sure. It's at Dave H. Contrarian. And you just have to be careful. It happens after every video, I think, is you'll get a few clowns out there that will change a letter in Dave H. Contrarian, misspell Contrarian or something else, and have my profile picture up there. Just don't get caught in that. I've only had it once or twice, but I had somebody reach out one time, I remember for sure, and he went on Telegram with one of these guys and paid money thinking it was me for something that the guy was offering. And he came to me, he said, "That wasn't you?" And I said, I have, at that time, I had, 300,000 followers maybe, but I said, I have big number of followers. These guys are typically, less than 1,000 followers, lots of times less than 100 followers. Yeah, you just have to be more discerning. So just don't get caught with these guys. I usually, when I see them, I ask people to report them.
Yeah.
And Twitter hopefully will take them down. But
Yeah.
it's just, I know anybody with a good following, a sizable following, deals with this. It's not unique to me, but social media has its good points, but it also has a lot of this crap.
Yeah, it's frustrating that AI can't deal with that. I mean, clearly you got over 400,000 followers using your picture. It's quite easy for AI to spot that. I just don't understand how they can't pick up on it quickly. But yeah, after some of the videos we put out, I had at least 5 scammers, and I put them. What they do is they copy you into a conversation, and they retweet the video as though it's you, and you just have a look. If it's only a few thousand, like you say, or hasn't got the blue tick, it's Dave H. Contrarian. So there's no Hunter in there, and over 400,000 followers. So just look for that, and please do report it, because they will get taken down, and we don't want other people to get scammed
I
by
had
these
an interesting
bastards. One,
which may be what you're saying. I had somebody after, it might have been my last, two videos ago. They were putting out a silver and gold forecast, and they're attributing it to somebody else.
Oh.
And they even attributed to that video, but they used somebody else's name rather than me. It was somebody in Pittsburgh that was a 20-year investment advisor. He wasn't even he wasn't professional investor, but they just picked up a name, put it in there, and it was all my stuff.
Wow.
And cited the video that my stuff, and it had just come out the week before, so I knew that. But it was some guy from Asia.
Oh God.
And I said I wouldn't have minded, because he got most of what I said right, if he had attributed it to me. I don't like it that they just kind of think they can steal your stuff. But I said I don't mind if they credit me, but he purposely didn't put my name in. And somebody said, yeah, they do that so they don't have a liability. But it was all my stuff with a fake name.
Yeah,
and it was a video. It was all him talking. But
that's really frustrating. So but just to remind people, you do actually produce a letter, and you can subscribe to that, but you need to DM you. So go to your X page, at Dave H Contrarian, go to the message section and message you directly. And then you can
direct message. I'd say that Twitter changed it to chat now, so it's X chat, and just send me an inquiry, ask for information on my letter. I'm glad to send out. I'll provide them the details of it. It comes with a cost. I just want people to know that it's not free. I have people that will message me and say, can you give me the link to your letter, or something. So it's a subscription. So you pay an annual fee for it. It's pretty reasonable for what I provide, I think. But everybody has to make that determination themselves.
And it's quarterly. You put the letter out, is it?
Yeah, it's a quarterly letter. I usually put it out the second week of the new quarter.
So one coming up.
And they get 1 year, and if they come in after the first the month that it comes out, for the next 2 months they'll get that letter plus 4 more.
Right.
So if my third quarter letter came out in July, like July 9th, up through July 31st, that'll be your first letter of your subscription. August 1st and beyond, you'll get that one, and then you'll be getting 4 more, and then each quarter I do that. So after it's 3 weeks old, I figure, okay, I'm not you're gonna get your first official letter will start next time.
That sounds very fair. Tim, with regard to media picks, are you okay with we're just going with the Bitten book and the video? Would that be all right?
That's absolutely fine. I just want to advise people, I made the mistake of watching Marty Supreme at the weekend, and I hated every second of it. So for those people who are open to new ideas, then Marty, perhaps as a contrarian, David may share that skepticism, but I thought it was a foul and disgusting film, and I wouldn't recommend it to my worst enemy.
Oh, wow. Okay, well, thanks for the warning, Tim. That's really appreciated.
I may just have been in a bad mood that day. So.
I doubt it. That's not your character. But Dave, look, it's such a pleasure, as always. Thank you so much for coming on and being, I'd say on behalf of the people that look at your stuff on X, thank you for doing that and trying to help all those people. Really appreciate it, and look forward to having you back on, and wish you all the best.
Yeah, thanks, Paul. Thanks, Tim.
Thank you.
Thanks, David.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.